If you invest into cover call ETFs like JEPI or JEPQ, this is going to be a really great article for you to pay attention to and really understand the ins and out of how these ETFs work. I came across this article here on Seeking Alpha titled Top Dividend Funds, JEPQ versus QQA for monthly income up to 10%. And the article was written here from Brett Ashcroft Green. I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. So this is going to be the second article that I'm going to review here on the channel from Brett. I'm actually pretty new to his channel. I'm going to give him a follow. I think he does a great job when it comes to explaining cover call ETFs. He does his research. He explains here that he was on the phone for hours with JP Morgan and, trying to understand how this ETF, the ELN, equity linked note strategy works. And so he does a really good job at explaining the ins and out of how these ETFs work. And he brought to my attention a new cover call ETF that I'm actually interested in now after reading the article, because this is a new one. It's not been around for a while. And so I'm going to be doing some more research on this other ETF. And this other ETF actually almost excites me just as much as it does as JEPQ, because they're very similar, but there's a few differences that he discusses in this article. But yeah, if you invest in a cover call ETFs, you like JEPI or JEPQ, this other one here, QQA from Invesco, I think sounds very, very promising. It's new, but I do like the index, and he explains it in the article here. All right, let's take a look at the article here. The summary is transitioning to a full-time writer. I seek stable liquid investments that outperform money markets, focusing on hybrid index funds with stock and option segments. After a 3-month investigation and calls with JP Morgan and Invesco, I compare Invesco QQQ Income Advanced ETF and JP Morgan's Equity Premium Income ETF. Both ETFs offer market exposure and liquidity, ideal for supplementing income through share sales without significant volatility. This strategy is for reallocating money market positions, not my entire portfolio, which includes long-term stocks and ETFs. So that's the summary of the article here. The only piece that I don't really agree with is the strategy around looking at these ETFs as, I guess, a way to sell your shares, kind of like a money market. Now, to each their own, right? I guess you could kind of look at this as a bond or a money market fund or an emergency fund, right? It's liquid, it's short term. Me personally, I really wouldn't look at these cover call ETFs as a means to sell off your shares, like reinvesting the dividends and sell them off. I mean, you could, I guess there's nothing really wrong with it. I just don't personally see it that way. If I'm going to, sell my shares, I'd rather have the money in a money market account, and where I know that the share price is not going to fluctuate and I know that my money's there. But, I can kind of see the appeal of replacing a money market with one of these cover call ETFs. I just personally do not really, I'm not the biggest fan of that strategy. But yeah, I would just see them separately, but that's just merely my opinion. I don't think there's really necessarily wrong with doing it. I just personally wouldn't do it. So he starts the article off here with 2 great monthly pairs. As I start to transition into a full-time writer and an individual partially living off of my investments, finding stable ways to beat money market funds and still maintain reliable liquidity has been top of mind. The recent trends in hybrid index funds that have both a stock segment in larger proportionality and an option segment have become very popular, especially as rates on money markets and high yield accounts begin to trend downward. This has also been a 3-month investigation into figuring out how all of these funds work, as they are all a little bit different. I've made calls to JP Morgan and Invesco and really appreciate all the help they have provided me with understanding these products. Today I will compare 2 excellent funds, the Invesco QQQ Income Advantage ETF, or QQA, and the JP Morgan Nasdaq Equity Premium ETF, JEPQ. In my opinion, both are great options to maintain exposure to the market and have a source of liquidity that shouldn't jump all over the place when you need to sell your shares to pay expenses. These are all things that I'm looking for, and the strategy has begun to make more sense the more I study these 2 sets of funds. Yeah, like I was saying, the strategy around selling your shares, reinvesting the dividends and selling them, I'm not the biggest fan of that. I would rather just live off of the income and budget that way. But yeah, I guess he's making a very clear case where he wants to replace his money market exposure with these, where I think you could actually have a decent size of your portfolio in this, maybe 10, 20% max, depending on your time horizon. So there's a lot of utility with these type of investment options. And yeah, I'm generally a big fan of it. And once again, it depends on your time horizon. I also want to emphasize that this is not a strategy I'm taking for my portfolio broadly. I have stocks and ETFs that I hold and plan to hold for as long as possible. To me, these funds are where I would like to start moving some of my money market positions to, positions that I would use to supplement income through share sales. Here are some of the differences between these two monthly payers. Here's a bullet point list of the differences and similarities between these two funds. QQA is managed by Invesco, and JEPQ uses a proprietary stock picking strategy to emulate the NASDAQ 100 and attempt to provide alpha to the strategy. So the big difference here is JEPQ is actively managed, and the fund manager at JP Morgan, they pick and choose what type of holdings they have in there. They follow, or it tracks the NASDAQ, but not it doesn't purely track it. It's a little bit different. Whereas QQA is an actual index. It actually tracks QQQ. And then on top of that, they write their option strategy. So this is what interests me about QQA is less dependent on a fund manager, and it more closely tracks the actual index. And I personally prefer that. I'm more of a passive investor than an active investor. And so as a passive investor who much prefers passive indices versus actively managed, that's what intrigues me about QQA. And I'm actually very interested in it. And I would definitely consider, considering, adding it to my portfolio. But I'd have to do some more research on it. But I do, at the surface, I really like the approach, even almost more so than JEPQ, because I'm more of a passive investor than an active investor. QQA uses the QQQ, or the NASDAQ, as an index to replicate the index fund exactly for the stock proportion of this fund. This is a true index fund hybrid versus a beta plus index emulator. JEPQ writes cover calls for the income portion of the portfolio. Against the NASDAQ futures, the strategy ranges between 15 to 20% of the overall portfolio. QQA writes calls and puts for the income portion of the portfolio against NASDAQ futures and has lower exposure at around 5 to 10% weight. So this 15 to 20%, this is their ELN, their equity linked note strategy. So 15 to 20% of the fund has exposure to this derivative strategy with JEPQ, and a lower percentage with QQA. So QQA is, in my opinion, more conservative, less risky, because I guess, risk is relative in this case. It depends on what the market does. But in my opinion, it tracks a more passive index and it has less exposure to ELNs, because the real risk here is with the ELNs, the equity linked notes, and the uncertainty, what happens there, the unknowns. And so there's less exposure with QQA. And that's why I'm really interested about this other ETF, and I would definitely consider researching it more and even including it in my portfolio. So I got this now. It's now on my radar. I'm going to put it on my watch list. So moving on here, you got JEPQ has a trailing dividend of 9.5%. QQA is expected to have a forward dividend yield of around 10%, according to Invesco and Bank of America Global Research. That 10%, it's difficult to say. I mean, this is forward, and the market's going to do what it's going to do. Maybe they're targeting a 10% yield for this fund, but whether it stays at that or not, it depends on the share price. It depends on volatility, on a couple of things. Both pay out the dividends and premiums as the total payout representative of the dividend paid by the fund. JEPQ has an expense ratio of 0.35%, and QQA has an expense ratio of 0.29%. And they have a promotion for the rest of this year. They'll have a zero expense ratio. That's fine. I wouldn't read too much into that. But going forward, it will be slightly lower than JEPQ. Now, once again, it is less actively managed because it actually tracks the NASDAQ, the actual index, okay? And so that's it's pretty interesting, actually. So similarities, both are run by very large institutions that have well-established derivative derivatives trading desks. Both utilize the ELN format for the options slice of the portfolio that provides income. Both pay monthly dividends. Now on to the most difficult part of these ETFs is the ELNs, the equity linked notes. And so this is the portion of the equation that had me up at night contemplating how it all works. I had read the prospectus of both and listened to various interviews with Hamilton Reiner. Hamilton Reiner is the fund manager of JEPQ, but I still couldn't quite figure out all the moving parts. After having a lengthy call with Invesco and chatting with JP Morgan a few times, I'm confident I have the crux of the equation, and it makes enough sense to me to make it be a viable strategy. So he has a image here where it has arrows going left to right, ETF to counterparty, you got note, and you got cash. So it's a transaction. The ELN is a sleeve to write synthetic futures options based on index. Okay, so this is a little bit more complicated. For those of you that don't have a finance background, this is probably going to be a lot of word salad. It's not going to really make a lot of sense. But he continues on explaining. So in order to avoid risking any of the actual equities in the portfolio being called away, the strategies simply take a proportion of the funds and fully fund their index future option positions with a counterparty. These funds are now encapsulated in note form, and any income from the buying or selling of options with the counterparty will be treated as income versus a return of capital. So this is the big difference between a JEPI, JEPQ, and now a QQA versus like the NEOs, the Teslas of the world, right? These other cover call funds where they have a ton of return of capital, whether that's destructive or not, time will tell, right? But you saw with QYLD that they've had NAV erosion and destructive return of capital. So we've seen that with the Global X cover call ETFs. But the difference here is when you're doing this with ELNs, so let me back up for a second. The risk with cover calls is in a bull market, you risk your shares being called away, meaning that the price goes over your strike price. Okay. And some of these other funds that don't do ELNs, they run the risk of having their shares called away, or they have to roll them, into the future. Like there's a lot more shenanigans, I guess I'll use the word shenanigans, that comes with investing into cover call ETFs in a bull market. In a down market, in a side market, it doesn't really matter because they're not getting called away or there's no risk of them getting called away. But in a bull market, this is a real risk. And you don't have that risk, as he's describing here in his article, with ELNs, with the strategy of JEPI and JEPQ. So in my opinion, if I can kind of summarize the pros and cons here, I'm going to continue reading here, but just a summary, the pro with the ELNs is you don't run the risk of return of capital, the risks of that because it's treated as income, and they don't have the risk of having their shares be called away. Okay, that's the pro. The con is there's not as much transparency in how the ELNs are set up. Okay, so the ELN structure, the conditions of the transaction, right, between the counterparty and the fund, there's not as much transparency around those. Okay, so that's, I guess you could say, the con. Okay, so that's my summary of how, if I could dumb it down for myself to understand, that's how I understand it. From my understanding, these ELNs both buy an index future from an established counterparty and then write a call option against them in most instances. This is usually done monthly to match the monthly income. The counterparty would make some money on the spread for the sale of the index future, and both the writer and the counterparty get a benefit. Eventually, this fully funded position of trading with the counterparty would mature or end, after which I assume the funds are then reinvested into the similar setup again and again. The strategy would be ratcheted up or down depending on where the portfolio manager sees the options market going. So why big institutions matter? There are many options overlay strategies out there, but only a select few can utilize the ELN ELN format to where the manager does not have to risk the underlying stocks being called away. And many of the smaller option stock ETFs we see in the market, NAV erosion is much more prevalent as the actual stock positions are getting called away to provide the yield to the investor. So this is exactly what I was just saying earlier, some of the risks with some of these other covered call ETFs, right? And the NAV erosion, you're not going to have this as likely with this strategy here with JEPQ and with QQA as it would appear, at least as it's being described here in this article. Oftentimes, the best options premiums are on the stocks with the highest momentum, and the manager, the fund manager, who cannot utilize an ELN format may have to risk the stocks with the best momentum, or RSI, the relative strength index, in order to keep up the yield. So this is exactly what I was talking about. In a bull market, some of these other covered call ETFs, they don't have this advantage where they could use an ELN, and their shares, they're companies that are, moving up, right? Like you see Meta going up like 100% in a year, right? Like it's very difficult to have that in a covered call ETF without it being called away, because then the fund manager, if they want to have Meta, they have to rebuy it at a higher price. Okay, so that's something very, very important. A big distinction between JEPQ and a lot of these other covered call ETFs out there. Only institutions with established derivatives trading desks could easily set this up, and I would only recommend the funds that are run by large institutions currently for that reason. Okay, so I made a video a few months back on these NEOS ETFs, SPYI and QQI. That was one of the videos that got a lot of love and got a lot of hate. A lot of people didn't like that video. A lot of people liked the video, and it depends on which camp you're in. If you like the NEOS ETFs, that's great. If you don't like them, great, whatever. Doesn't matter to me. But it's important that you understand the differences, the strengths, the pros and cons of investing into a smaller company, a small fund, where, fund manager with less capital, economies of scale, brand recognition, et cetera, compared to going with the big guys, the JP Morgans, the Invescos of the world. And in my opinion, one of the arguments that I made in that video was I want to go with JEPQ because of the reputation that, with JP Morgan, right? Going with the big guys on Wall Street, I guess you could say, right? And so I worked really hard for my money. I much prefer to put my money where I can sleep well at night, where I'm not taking unnecessary risks. And so that's why I'm such a bigger fan of JEPQ, is largely because of that, right? I don't want to wake up and have like a Bernie Madoff situation randomly. And I'm not saying that that's like, when I use that extreme example, the Bernie Madoff, I'm using that as I don't want to be, have the gotcha, right? I don't want to take part in a gotcha on the bad side, right? And I don't think there's going to be as many gotchas going with JP Morgan as an example, compared to a small fund that's, startup that's been around for a couple of years. But anyways, the holding comparison. So you got JEPQ's top holdings. All right, so as we can see with the JEPQ, the top 10 holdings are a bit different than the NASDAQ 100, which we can see below with QQA and QQQ, with the higher weighting of options in the JEPQ portfolio. One of the ELN option notes also makes its way into the top 10 holdings. This portfolio does have a more active management and turnover than QQA, which simply seeks to match the QQQ index fund. And that's what I was talking about earlier. This is why I'm actually interested in QQA, is it actually tracks the NASDAQ, right? And so there's less of an actively managed approach to this fund, and I do actually like that. So as we can see, QQA is a true index fund replicator, as the top 10 of QQA are exactly the same as QQQ. There are some different holdings proportionally due to the cash and the ELN positions, but the strategy is the same with no turnover unless the index changes. So why monthly matters? My strategy with these funds is not to use the income as it rolls in, but rather reinvest it to smooth out my principal balance. As the funds hold stocks, they also move with the market, although their beta should be much lower than the market in general. So this is his strategy. Like I said a couple of times in the video, I'm not the biggest fan of this approach. I don't see nothing really wrong with it. To each their own, tomato, but I personally would rather use the income as it rolls in versus reinvest it and then sell it. So his strategy here is monthly reinvestments will keep the return trajectory line smooth. Then depending on the market conditions, bull or bear, I would simply sell last in, first out, or first in, first out. In a bull market, I would be selling last in, first out, as my older shares probably have more capital gains. And in case of a bear market, sell first in, first out, assuming that the earliest sets of shares have small tax loss harvesting. With monthly reinvesting, this selling of shares strategy should work out overall, as selecting individual share tranches by date usually has a tranche limitation. This is how I intend to operate this strategy for liquidity once I start moving some money, some money market funds to utilize tax efficiency. Yeah, this is a little bit of a more active approach. I would say 95% of you watching my channel, I don't think that this is going to be the right approach for you. But there are 5% of you, I would assume, I'm guessing obviously, where that could be, like, hey, that's cool, let's tinker with it and let's see if we can squeeze out a little bit more juice out of the lemon. If that's what you want to do, you want to squeeze a little bit more juice out of the lemon, I think that's completely fine. So examples of muted volatility. So here he goes and he shows the historical performance of JEPI, JEPQ, and then JEPQ, and then JEPI, 3 different portfolios. I don't really put a lot of weight into, the importance of this because these funds have only been around for a small handful of years. So when I backtest, if it doesn't have more than a couple of years, I don't even waste time on backtesting it. He's trying to make a point that there's less volatility, less beta in these ETFs, which is good, which is true. So why own multiple? My opinion is owning a few different covered call overlay funds diversifies risk as it relates to the options trading strategies. As ELN agreements are bespoke to the negotiations between the two parties involved, these are not items that are disclosed and will perform better or worse depending on the talent of the manager. Knowing how this works better, I now would only want to be involved in the index fund option overlay products that have institutions behind them that are large enough to execute the ELN structure. My hangup on these was the NAV erosion possibility due to the writing call options against actual owned shares, which then creates further investment risk after the manager gets back a chunk of cash for a stock that is now more expensive to go in and repurchase in the market. Now that was really cool. That should have been in his summary of the article, is before he was losing sleep at night over these ELNs. And now he won't buy a covered call ETF unless it has the ELN structure. Okay, I guess doing your own due diligence makes you more confident in your decision making. I think that's awesome. So other options, other great products from the two companies that I would intend to cover later would be their more value-oriented products, namely the JP Morgan JEPI, the Invesco, the SRSPA, with JEPI more or less indexing the low volatility S&P 500 index, and the RSPA mimicking the equal weight. Okay, yeah, so these are other covered call ETFs. I guess, I see JEPI more as truly like a bond alternative with a higher income potential and a little bit more growth potential. You see that JEPI has underperformed JEPQ. It's just simply how these funds are designed. And you just have to understand that if you're investing in a JEPI, you're not going to get a lot of growth from it. It's going to be a lot more, consistent and stable in its income and its performance. But I wouldn't, go and assume that you're going to get great returns in JEPI like you are with maybe some of these others. Both of these, again, sell options within the ELN wrapper, which protects the stocks from being called away while still providing monthly income. So some of the risks, all of these strategies have risks associated with their option slice, which also entails counterparty risk. The main risks associated with the structure are laid out here by Invesco and should be consistent with all of the option overlay funds. So all of the ones that have the ELNs. So their statement around risks from Invesco: investments in ELNs are susceptible to the risks of their underlying instruments, which could include management risk, market risk, and as applicable, foreign securities and currency risks. ELN are also subject to certain debt security risks such as interest rates, credit risk. Should the price of the underlying instruments move in an unexpected manner, the fund may not achieve the anticipated benefits of an investment in an ELN and may realize losses which could be significant and could include the fund's entire principal investment. An ELN That's a big one. And that's risk, right? You could lose everything. That's just how it is in life. And ELN investment is also subject to counterparty risk, which is the risk that the issuer of the ELN would default or become bankrupt, and the fund may not be repaid in the principal amount or income from the investment. ELNs may also be less liquid than more traditional investments, and the fund may be unable to sell ELNs at a desirable time and price. So that's the risk, the disclaimer around ELNs. But here's the good news. Again, this is limited to the slice that produces the income. And these funds further diversify the risk by first splitting their ELN proportion amongst multiple ELNs with multiple counterparties. So they don't have all of their exposure to one ELN with one counterparty. They spread out the risk, but also, JP Morgan, they only have 15 to 20% of the fund in ELNs, and QQA only 5 to 10%. So the quote unquote could lose the entire principal investment. Yeah, but first off, it's diversified across multiple counterparties, and it only represents a small percentage of the overall fund. If that doesn't give you peace of mind, I don't know what will. And then lastly here, also please note that some platforms may not allow you to trade ETFs with active management and or futures tradings baked in. As of right now, Merrill Edge in particular does not allow investors to buy or sell some of these products. Yeah, if I'm on Merrill Edge, I'm transferring my brokerage to somewhere else. All right, in summary, for those of you looking to get more exposure to the market by redirecting capital into equities, these two funds provide a way to do that with lower volatility and not too much capped upside. Again, these products I think are excellent for a portion of your monthly expense accounts that you intend to liquidate to pay for day-to-day income needs. I still believe the majority of one's portfolio should be in long-term buy and hold stocks and index funds. Both of these are run by large reputable firms that have advantages in writing options against smaller boutique firms. Both of these are a buy. Okay, that's the article. Let's take a look at a few comments. First comment here, honestly fascinating. Thank you for taking the time to dig through this and to explain it in a way that this novice investor here can understand, at least sufficiently to make hopefully better and better decisions. Great stuff. Yeah, he does such a great job in this article at explaining the ELNs and explaining the similarities and the differences. The reason why Brett does such a great job is he takes a complex topic and he makes it simple so that just your normal person can understand this. We're talking about derivatives, right? Derivative strategies. And he makes it so clear and understandable that just the average person can understand it. And that's why I'm such a big fan of, this is the second article that I've read from his, and I really, really like it. I like the way that he writes. I like how he explains things. He makes it so that it's not intimidating. And he doesn't, another thing, he doesn't use complex words to make himself seem smarter than he may be or to make it more complicated than it has to be. So I really appreciate that about his writing. Another comment here, one point that I don't understand is liquidation. Why liquidate ETF units when you can simply use the monthly premiums? Yeah, I'm in the camp with this guy. I personally am not the biggest fan of liquidating, but he responds here, thanks for reading, works either way. I treat it like a money market fund that automatically reinvests. Some months you may need all the income and some more. Some months you might need none. So yeah, I do like what he's saying. It gives you flexibility, but for him, it's very clear this is his money market fund. For me, it's like the purpose of it is to live off the income and not sell my shares, right? So to each their own, it's a different strategy. So that's the article. All in all, I would give this article an A. I think he does an incredible job at explaining what JEPQ is, what this other ETF is, QQA, really understanding the similarities and the differences of these two ETFs. I love that he really breaks it down in simple terms that your normal person can understand it. I really like how he explains the ELN, the equity linked note strategy, because this is probably the most difficult part about JEPQ and JEPI is they take a different approach. But after really understanding what they are, and you can see that he did his research, I like the word he used, investigate. He's like a little CoffeeZilla here for these ETFs, but he investigated these, how these ETFs are set up. And I will be frank, I understand them more because of this article. And something that I really like about this is the ELNs could actually be a USP, a unique selling point for these ETFs compared to some of these other smaller ETFs, smaller firms that are not able to take advantage of the benefits of ELNs, right? So a lot of people try to paint these ELNs as a negative because they don't understand them, which I get and I can understand. But if you peel back the layers, which Brett did in this article, you can see that it could actually be a competitive advantage for these funds. And that's what it appears to be. So all in all, I really like the article. I learned something new myself. I am definitely going to be taking a look at QQA. May make an entire video on it down the road, but it is a very new fund. So I like to see a little bit more performance. I like to see a little bit more, gather more data on it before I make a video, but it sounds very, very promising. And I think if you're interested in covered call ETFs, I think this is definitely something that you could consider. But yeah, thank you so much for watching. I hope that the video was helpful. I hope that you learned something new, and I'll see everybody in next week's video.